Welcome to Barchart's series of educational webinars designed to enlighten you on a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer some traders' insight to help you make a more informed trading decision. Today's subject, shorting stocks with precision and accuracy. Now, shorting stock is the act of betting the price of a stock will fall in the near future. Contrary to opinion, all stocks do not rise with time. Companies fail, market conditions change, and even market leaders eventually hit a wall of worry, which changes investor sentiment and induces profit taking. So, to clarify this concept even more, short selling opportunities are simply recognition of changes from uptrends to downtrends. And chart analysis and other basic technical analysis can offer clues to these changes in characteristics from up to down trends. And savvy traders can pinpoint shorting opportunities when the newly developed downtrend makes those lower highs, which defines a dropping stock price. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist, and there are three ways you can short stocks. You can borrow shares and then sell the shares with the anticipation on prices will fall. And when prices fall, you repurchase them at a lower price and return the borrowed shares. Now, during this time of borrowing, you'll have to pay an interest on the value of the stock, and you're liable for any dividend payouts. Second way, you can purchase a derivative like an inverse ETF or an option, which benefits from falling prices. And the third and the most simple way to short the market is just being out of the market. In other words, selling longs or refraining from purchasing. Now, all these have benefits and risks, and today's session is not going to be deciphering those distinctions. Rather, we're going to learn how to identify the conditions that are conducive to shorting opportunities. The decision will be yours of how you want to short. But I will say that one common risk of all shorts is time. Time in the trade, time market could reverse, time which decays derivatives, time not in the market, and missed opportunities. However, if you give me some of your valuable time today, I believe I will reveal the attributes, conditions, and some timely entry points for high probability shorting opportunities. Now, before we get to that, please welcome our moderator and Barchart's project director, Gene Baker. It's been a while. Hello, Gene.
Hi, John. Yeah, it has been a while. I almost forgot how to do this.
Me
But
too. Me too.
yeah, but you were talking about time. That's time. Time is of the importance. So, know you have a lot of content that you plan on covering today. So, time is of the essence, and I'm going to let you get right into it.
Excellent, Gene. I love it.
Everybody just send your questions in and I'll be passing them on to John.
Awesome. All right, just a reminder that today's session is for educational purposes, and decisions to buy, sell, or hold or trade securities, commodities, or any other investment is best made on the advice of qualified financial professional. And certainly short selling is probably one of the more difficult and risky types of trading. But under no circumstances shall we be liable for any losses or damages you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on the information or material you receive through barchart.com and or our services. Okay, so let's start with conditions. And, it's pretty obvious to say something like When it comes to looking for short opportunities, we're probably going to be more successful if we're looking at a broader bear market. Selling into a strong bull market is like swimming against the tide. Difficult, but not unachievable. But swimming with the tide is just that more easy. But keep in mind that bear markets typically run shorter in length than bull markets, something like 6 months to about 2.5 years. But that being said, inside of bull markets, there are still companies that fail and stocks that trend lower. So here is a list of 100 stocks in the last 52 weeks that have literally fallen almost 100%. Now, they have already fallen and they're probably not good shorting opportunities today, but at one time, these were good shorting opportunities. And it's just an example that even in bull markets, there are bear opportunities. Another condition change that we might be looking for is this rotation or market cycles. For instance, we move from a period of expansion to contraction, or rotation into or out of particular sectors, technology and consumer discretionaries, and then maybe cyclicals, materials, and then energies, and then eventually a rotation into defensive sectors like staples. Now, as the current market's broader market right now index is running into all-time highs, another all-time high today, under the hood, there are many stocks that are not participating in this rally. And so one simple metrics to check performance is moving averages. And a moving average basically tells us that stocks that are in an uptrend tend to stay above their moving averages. Stocks that are in a downtrend tend to stay below their moving average. And two moving average metrics that are industry-wide accepted are the 50-day and the 200-day. And you can see that currently today in the S&P 500 index, there's only 40%, 47% of the S&P index stocks are above their 50-day moving average. That means there's a larger percentage that are exhibiting bearish or downtrending tendencies. Now, if you click on this and you open this up, you will go to a chart. Now, I've manipulated this chart. What we see here in red is a moving average of the 50-day moving average, and you can see that even though the S&P, which is overlaid on top, has been rallying, we are seeing less and less stocks above the 50-day moving. In other words, that bearish tendency. Now, if we go to the 200-day moving average, notice that the value here is 67. That means 2/3 of the stocks in the S&P 500 are above their 200-day moving average. That is usually a healthy sign. But 1/3 of the 500, about 170, are below the 200-day moving average. And Paul Tudor Jones taught me nothing good happens to a stock below its 200-day moving average. And so that third are going to give us better odds of shorting opportunities. We can talk about economic news cycles. And so if you think about stocks, one of the news cycles we could be referring to is stock earnings. And earnings certainly are catalysts to change trends. But when we talk at the macro level, we could talk about how monetary and fiscal expansion versus, let's say, monetary tightening like the Fed. But think about, how the market runs ahead of impending positive news, but stalls or reverses once that news becomes public or released. The old buy the rumor, sell the news. And then patience based on time. We're going to be able to recognize rollover and changes in trends, but it's important that we wait patiently for optimal opportunities. In other words, low risk, high probability trades, and not to suffer from FOMO, or the fear of missing out. So we're not going to chase downside price action. Instead, we're going to wait for the market to come to us and give us the correct sequence and signals to take a trade. So let me just kind of give you an example of that. So this is the CareMax, and here is a chart. Let me squeeze this down a little bit here. Here's a chart over the last 3 years, during the last 3 years. Now, if I look at this chart after, we're going to go through a lot of stuff today, but looking at this chart, I only see about a handful of really optimal opportunities to sell this stock short, as the stock literally evaporated from $400 to currently $2. So let's talk about chart patterns. And when we're studying chart patterns of, let's say, market leaders or stocks that have had a good run, or but are starting to beginning to lose momentum or interest, or maybe they've reached some extreme valuations, a common transition pattern is something called a head and shoulders. Now, a head and shoulder is a change in characteristics from an uptrend to a downtrend as the market moves from higher highs and higher lows to lower highs and lower lows. So here's an example of a head and shoulders, and you can kind of see how this stock was continuing to rise. It made a higher low and higher high, a higher low, a higher high, and then we make an equal low, and then market rallies again, but this time it makes a lower high. The transition from an uptrend to a downtrend. Now, this pattern itself might not be optimum for a shorting opportunity for several reasons. First of all, you have to be this timing of being right when we break the neckline. And there might be too much risk to reward, or you might endure a false breakdown. But a completed head and shoulders pattern is an excellent indication of a change in trend, and shorting opportunities that present themselves after a head and shoulders are typically have greater probability. In other words, patience for looking for those opportunities. So again, if we look at this here, once the market breaks the neckline, you usually get an extended move that is equal to or relatively the same as from the head to the neckline, as we saw here. So that would have been the completion of the head and shoulders pattern. For a shorting opportunity now, we're going to wait for the market to come back and retest this neckline, or even as high as the right shoulder. That first retest is going to give us a much higher probability. But think about this in terms of trend analysis. That first retest here is a lower high, which defines a downtrend. Now, I do have a V bottom here. We'll talk about exits a little bit later today. But just kind of remember this pattern here. V bottoms are an excellent indication when you are shorting a stock that it's time to exit. So we'll talk about exits in a bit. But head and shoulders can also be looked upon as something called as a distribution. Now, distributions is where shares change hands. Again, I don't want to insult anybody here, but from the smart to the dumb, or institutions to the retail, or to the wise to the greedy. So distributions can be identified as sideways price actions with a lot of swings back and forth. And you will recognize that by large body candles. In other words, large green candles and large red candles as the market swings back and forth. Now, in this example here, we see a rollover pattern, but more commonly, you might see what it would be called a trade range, more of like a square box. But notice that there is a neckline of support, and then we get our breakdown candle, very similar to our head and shoulders. Again, timing-wise, this might be a good shorting opportunity, but we're risking selling into a potential rally, and we need to wait for that confirmation or that first retest. So notice how we have our breakdown here. And then what does the market do? Well, it tries to recapture this 50-day moving average. And this is a very common attribute of this transition from a uptrend to a downtrend, this little recapture segment of a price movement. Some market technicians would call this a bear flag, and usually you can recognize it by a lot of small candles. Again, what we want to see is price trying to recapture one of those moving averages that I just mentioned, that 50 or maybe the 200-day. The failure to recapture and the breakdown right here is that more timely entry. And then at that point, what we can start to think about is a new lower low. But also notice here that this first retest of this bear flag comes in an area where the market broke down before, and where support now has become resistance. And again, here we see, if we miss the opportunity here we see another breakdown below a level of support, and then that crawl back where we come back and test not only the old support, which becomes new resistance, but a failure to recapture that 50-day moving average. Now, what is different between this timely entry and this one is now that our 50-day moving average is down sloping. And then again, a failure to recapture that. Notice now here, our price falls to our 200-day moving average. Again, a much higher probability of breakdown and follow through. Now, when you're looking for these breakdown retests, as we see here, or as we will talk about here, be sure to be conscious of gaps, and notice that you will see some partial fills, as your market attempts to recover, make a recovery high, so to speak. And that is where we're going to see these lower previous peaks, right, from our lower peaks. Again, that series of lower highs. So you can see how the pattern here, we broke down below the 50-day, we fell to the 200, we fell below the 200, recaptured the 200, but then broke down. Again, maybe not a great timely entry, but wait for that retest failure, which would have been a much higher probability entry. So study this chart. Again, this is very common type of pattern as a market transitions from long to short. And notice how we're seeing this change from higher highs and higher lows to lower highs and lower lows. What we want to do is wait patiently for those retests where the market tries to rally, make a new high, but in this case, a lower high. Another pattern that we can look for is called a parabolic or climatic top. In particular, the ones that I like to look for are a candlestick pattern that I call pinchers or twins. There's a lot of different names as you might hear from them, and you can kind of see them. What they have is they have very similar uh, uh, tops to them. And so what you want to do is, again, this is like our head and shoulders, maybe not optimal in timing entry, but that first clue of a major change is afoot. So what we want to look for is a series of gaps leading into our twins or this kind of this parabolic price movement. And then looking at these two candles that have relatively same tops. Now, usually you'll get a gap break or you'll get a series of rapidly falling down candles, red candles in this case. The optimum entry will be that retest of a partial fill of the gap or touches of where the gap is, but we don't want to see price return more than halfway into our twin candles. So I did this slide on Dell based on this observation a few weeks ago when I was preparing for this presentation. So let's go to Dell today. And again, one of the things that we need to understand is that our 50-day moving average, our condition is still bullish, right? Our trend is still up. But this is where we're kind of looking for that breakdown. Again, that optimal signal, right? We could have gotten that trade here, but maybe what we want to do now is we want to see that change in characteristics. In other words, here's that little bear flag. And well, now a breakdown would probably set about changing a 50-day moving average from moving upsloping to probably starting to move downsloping. And then we'd get a little bit of a breakdown, then a bounce, maybe a bounce off of the 200 days, and then, a retest of where we broke down. Where would that be? Again, just estimating probably a previous level of support or, the candle that breaks down would be probably a great level. Again, that would be something that we can anticipate. But let's go to look at a market that has already exhibited this. And here's Starbucks, and let me kind of squeeze this up a little bit here. And there you can see our twins, right? This parabolic move. And again, maybe not a great opportunity to short, but certainly that information that we're going to gain from here as price breaks down. Notice that there is a little bit of a gap here, then rapid succession of red candles, and eventually we break support. Notice that support here also coincides with our 200-day moving average, and what's different than what we saw in Dell, our 200-day moving average is down sloping. And then there's that little attribution, right? That little bear flag that we normally see. So all this price action, don't fear, don't FOMO on me, right? We need to get that confirmation. And there's that little attribution confirmation. So we're going to wait for that first retest into the zone, right? Where the market makes that next lower high. Now, what's kind of interesting about this example here is notice that our twins here, I'm in a daily chart here, our twins here, where did price stop going up? Well, it stopped going up in one of those little bear flags from a previous parabolic move. Now, this one at the daily level does not create twins, but if I change my time frame, which is an important thing to do when you are measuring or looking at market characteristics, here I'm on a weekly chart, and there you see the classic twins and engulfing candle. And notice that our previous daily twins falls into this zone here. And for my supply and demand traders, you will recognize this as a drop base drop. That area represents a level of supply or resistance. So the coincidence of twins in an area of supply and then that confirmation as we roll over, looking for that retest, that better timely entry. All right, so let's talk about old support and new resistance. So again, when we see some of these patterns, these distribution patterns or these head and shoulder patterns, you will discover levels of support. And when the market breaks down from those levels of support now become levels of resistance. Now, notice in this example here, let me get rid of the volume here for a second. This is Salesforce. Here we see a market that is rallying and it gaps up and then creates this level of distribution, right? This kind of sideways action where we see a couple big red candles up and down and a couple of green candles up and down. And there's our level of support. Then we break down, right? Again, this would be not a very easy, timely trade. By the time the price had already fallen, it's already moved. So this is not a shorting opportunity as a breakdown, but we want to wait patiently as price returns, right, to a partial gap fill, to return to old support. Now old support becomes new resistance. And in this case, which is very interesting, is because we gapped up and gapped down, this is called an island reversal, another reversal pattern that is very indicative of a trend reversal. But again, let's look at this here. We see that price comes down to a level of support. Again, a big gap down. Again, not going to be a selling opportunity down here. We're going to wait for price to return to our support and look at that support as a level of resistance. And that would be a more timely entry. Now, let's put our moving averages on top of this. And let me get rid of this. And notice that this partial gap fill right here, where we failed to recapture the 50-day moving average. So why didn't it go all the way to the resistance? Probably because price had reached this downsloping moving average. And again, here is an example of a downtrend where we may get a higher low, a lower high, but a market that is trending will stay below its moving average. And again, notice here we have a return to above the 200-day moving average, but a failure to get above the former level of support, which now becomes a level of resistance. A confluence of evidence that once we get that breakdown, that rollover, this would be a much more timely entry and also a higher probability entry that price is going to continue to go down, and in this case, probably make a new lower low. And then the final piece of the puzzle in chart patterns is volume. I don't want to just go back to Starbucks. And so when we look at volume, there's a couple takeaways that you can use. And first of all, is usually when you have spike volumes on these breakdowns, that is usually a bit of a sign of capitulation. And these are not selling opportunities, right? This is after the fact, right? The price has already fallen. So we want to be wary of those. What I would rather look for is when price returns to a level where I anticipate an entry, I either want to maybe see a little bit of a spike volume, but then a failure of volume. In other words, if I recapture a moving average, maybe I don't want to see a lot of volume after I capture that moving average. I don't want to see that participation in new length. I want to see kind of a falling volume. So volume on the downside, spike volumes are kind of indicative of, hey, let's wait. And then we're going to wait for price to return. And then when we get back to those levels where we're anticipating a potential selling opportunity, we don't want to see that confirmation. We don't want to see a falling volume or a lack of volume. And this would be a greater sign that our trend, right, will become back into play as the market is asking for buyers to step back in and buyers refuse to come back in. And so then sellers will step in and drive the price down. All right, so let's talk about risks. So what are some of the risks we have to consider as a shorter or taking shorting trades? So the first is just a generality about how markets behave. Bulls take the stairs and bears take the elevator. In other words, the characteristics of uptrends and downtrends are a lot different. So what does this really mean to you as a short seller? So we don't want to chase the elevator down, right? The elevator and down drafts. If a market gaps down, so be it. Let it gap, right? That's fine. We're going to wait patiently as the market stair climbs back to those levels of resistance where we are anticipating that that's where price is going to stall. Bear rallies are swift, vicious, and sometimes even lengthy. I bet you didn't know that some of the single largest one-day gains in the broader market indexes occurred in bear markets. And it's not unusual to find 20% rallies off of lows in bear markets that continue to go lower. So 2 points here. Why we don't chase after price has already fallen, because when it becomes obvious that everyone else that price is falling, that is usually when we get those reversals. And two, that patience, right? Wait for that rally to exhaust itself, right? If it's to be, the market will give you that retest entry. Those gap fills, those those moving average captures and failures, and then those resistance at old support or the lower levels of our distribution areas. Percentages from peaks. So this is a concept that we need to be conscious of price movements from our previous peak. Now, most bear legs or impulses are in, let's say, the 8 to 15% variety. So if you're setting up a trade to select a target or be prepared to exit a trade when you reach some of these percentages. So again, here's our Starbucks trade where we had this opportunity here to more ideal entry. And if I look at where price fell to in terms of a percentage, that was about a 13% drop. Now, if we go over here to the left, there is that lower levels of support. Now, if you wanted to break this down and look inside here, there's a little gap here, and this was a gap fill support. So be prepared when you take these types of trades that you're going to take little chunks out of the market, these 10 to 15%. Obviously, if we use some risk management techniques, we might stay in a trade a little bit longer. But again, being more prepared in these typical types of impulses that we see in bear markets. And then time. Again, time in the trade. The longer we're in the time we're in a trade, there's a higher probability that we're going to get some type of reversal. And remember, bear rallies can be very swift, happen very quickly. So we need to be a little bit nimble and make sure that we are on top of things. But also in terms of how long I'm planning to be in the trade, right? I might stay in this trade for a few weeks or maybe in a few months. But again, how do I determine where I'm going to take profits? How do I determine I've been in the trade long enough? Again, trend's your friend to the bend at the end, in this case, a downtrend. But again, the longer the time we're in a trade, the more probability that that trade is going to reverse on you. So that brings us to exit plans. And if I'm talking about exit plans, here's one of the adages that I believe in that for many years is talked about on the floors. Bulls and bears make money, right? Traders who have a plan and have an exit strategy tend to make money. Those that don't have a plan or are just pigs, they usually get slaughtered. So when we set up a short trade, we want to preset trade targets. Now, these could be multiple of values. It could be a lower moving average, let's say as we fall from the 50 to the 200. Could be a previous lower support level, like the example I just showed you on Starbucks. Or again, that peak percentage from the most recent high. We can use something called average true range. So what you might do here is, let's say you set up a trade and you're going to risk 1 ATR. And what I want to do then is, can I select a target that is at least 3 ATRs away, a 1-to-3 ratio? And are there any speed bumps in my way between that and that 3 ATR number? The greater the number, the more profitability that I can have. So again, let's go back to that Starbucks trade. And let me do this. Get rid of volume. So first of all, let's say here was our potential entry. And again, let me put the moving averages back on top of this. And again, I'm going to have to get rid of this. So notice that our 200-day moving average is just above our potential entry. Now, I don't know where our entry would have been. To say that we sold the top would be very foolish. But I could come back into Starbucks here and Under technical analysis, find the average true range. And you can see here, average true range has always changed, but it's about $1.50 on the large end. We're going to be very conservative here. Let's go back to our chart. So my entry would probably be depending on where I'm going to set my stop. Maybe I'm going to set my stop above my 200-day moving average. And on this particular day, the 200-day moving average was at 98.78. So maybe $1.50 above, or $1.50 from wherever my entry is. Now, I would say that my guess at an entry would have been somewhere around 97.75 to $98. So we added $1.50, that would be 99.50 above our 200-day moving average and outside of one ATR. But if I'm going to risk one ATR, can I get three ATRs? So three ATRs on 1.5 is $4.50. And where is our nearest level of support? Well, around 91.68. So if I get it at a 98 and I risk $1.50, can I make $4.50? In this case, yes, I can. That is being conservative in the risk reward ratio. But think about this. This low, we know if we're in a downtrend, we're going to make a new lower low. And so this trade actually turned out to be a lot more profitable. But designing the trade and designing the preset exit is based on this ATR concept. Put to call ratio. Again, when I go to my individual stock, I will be watching the put to call ratio. And you can find that right here. And so again, depending on how much time I'm going to be in a trade or on what I'm anticipating the time of day, I'm going to look at my put to call ratio in terms of volume and open interest. And I kind of tend to focus on the first monthly, and I'll watch that volume and open interest. In this case, what I want to see is extreme put activity. In other words, I want to see it above 1 or greater. So the open interest right now is high, but the volume is not there. When both of them are above 1, to me, this is a crowded trade, and then this is permission for me to exit that trade. V bottoms, right? I showed you that example on our head and shoulders slide. Looking for high volume events after the market has dropped dramatically. Again, let's go back to Starbucks. We'll go to our chart. We're going to add volume. These are some templates of my own. One of the benefits of being a premium member is you can create an unlimited number of templates. Oh, I think I just got rid of volume. Okay, so again, here was that kind of that V bottom in Starbucks. So a lot of times what you'll notice on V bottoms is you'll see a spike in volume preceding what will become the bottom of the trade. So that is a kind of a clue, right? And this is a bit of a sign of capitulation as well. But if I see a spike volume, or I see price recover above the candle that created the spike volume, or above, let's say, the last several down days, especially if I see that with maybe a gap up or with a rise in volume as well, that would be a sign of a V bottom, and that would be also a determinant for me to say, hey, it's time to exit this trade. And then we could talk about trailing stops, which is a great tool to use. And I set this up this morning, and I went back to just checked on it, and let's see if it's still there. Okay, so let's go to let's go to Walgreens here, And let me kind of give you an example of a technical trailing stop. So again, here's our area of distribution. There's that attribute that's very common where we try to recapture the 50-day, but here it also coincides with a downsloping 200-day. So let's assume in this case that we waited for the breakdown and then we sold the retest. So maybe I would set my stop, let's say, somewhere's in this area. Well, then what I'm going to do is as price falls, as we make a new low, I'm going to bring my stop down to the last peak high. So that would have been, in this case, probably close to my entry. Then price rallies backs up, goes back down, makes a new lower low, and then I'm going to lower my stop off of the next peak high. Again, price rallies back up, makes a new low, and again, I'm just going to keep moving it down every time we make a new low. Now, here we see price is falling. We make a new low, and then maybe I would have set, let's see how far, well, yeah, we still would be in this trade. Here we go. So again, make a new peak low. We lower it to here, and then we make a new peak low, we would lower to here, and then we make a new peak low, and then we would lower it to here, and then eventually we would get stopped out. So that is a great technique to stay in a trade a lot lower. Wait for the market to make a new low, then adjust your stop off of the previous high. All right. I see a couple questions. I want to show you guys some resources, but let me see if I can take a moment here and answer some of your questions because I do want to get through a lot more material here. So Henny asked about earnings. Again, how do you anticipate that? Just know that earnings is a catalyst for price movement. What we want to see then, Henning, is are we seeing one of those chart patterns develop after an earnings? If we do see that chart pattern, then we have the game plan of waiting for that either the completion of that pattern or again that retracement. I got a very specific question about using other moving averages, exponential, or different time frames. And again, every trader has their own system. Yeah, so just do me a favor and send this question to support@barchart.com and then ask them to forward it to me so I can spend a little bit more time answering that question. So another question, do I prefer shorting stocks outright or use an option strategy? So I do tend to lean more to doing options, but what's the risk of an option? Again, what's the risk of all shorting opportunities is time, you're timing well. A lot of times, many of these shorting opportunities take a long time to play out. For instance, here would maybe from August to October, that would have been 60 days. The cost of an option out 60 days might deteriorate a lot from my potential profit. So it depends. It's a mixed bag. It depends on, if I'm getting fair value for the options. So David asked, is setting the stop at one ATR increase? Yeah, anytime, basic rule, David, is the closer you set your stop to current price, the higher the probability you're going to get stopped out. Again, I'm just giving an example. If you want to use 1.5 or 2 or 3 times the ATR, that's fine. But then when you set your target, that just means your target is farther away. So we need some kind of a balance between what risk we're willing to take and what profit potential that we can anticipate. All right, so let's talk about some resources that we have at Barchart and how you can use them. So here's a slide that talks about those different resources. So let's talk about the first one. The first one is the death cross. And that's where the 50-day moving average crosses over the 200-day moving average. And where you can find that is under investing, where it says Barchart screeners. Go there, and there you go. There's our death cross. So these are all stocks today where the 50-day moving average is crossing over the 200-day moving average. And that's usually a distinction in the market is in a definite downtrend. But the caveat here is that many times when this crossover comes, that the market has already been in an extended downward move. So I mean, just let's look at a couple that are right here. Now this is not an example, but here look at UNP, which is Union Pacific. So right here we're getting the 50-day moving averages crossing the 200-day moving averages. Definitely a confirmation that we're in a downtrend. But what do we need to do here, right? We need to wait for our optimal entry. Maybe we need to wait for price to get back close to our moving averages, or find a structure that is more conducive to an optimum entry. Again, probably this market has already made a low here. We probably need to find that lower high for a more optimal entry. Another reference tool that we have is, let's go to new highs and new lows. And I'm going to go to the summary page in new highs and lows, and you can see a lot of different new highs and low categorizations. So I would sort between new monthly lows and new three-month lows to finding candidates. And what we want to do here is we want to look for those that haven't already fallen a large percentage from that time frame highs. In other words, this 3-month high. So notice a lot of these stocks have already fallen, 20, 30, 80%. We want to kind of concentrate on those that have only fallen a small percentage from the most recent high. Again, these still could be good candidates, but be prepared to wait for a potential entry. But for instance, here we're looking at a Visa, MasterCard, very two similar stocks, right? These are breaking down on some critical moving averages, so these might be a better timely entry. Where the first trade, which was a little bit, excuse me, not. Let's reverse this. Hang on. Let's go back and reverse this. Here are, let's see, I mean, look at, for instance, let's look at Kellogg's, right? A very common. It's 35% off of its 3-month high. And where is it? Kellogg's there, right? So yeah, it's been in this downtrend. Has it had one of those, have we had a correction reversal, and have we had created a new lower high? No, or not. So we'll probably need to be a little bit patient and look for a better optimal entry. All right, another resource that you can go to is all top stock picks. And what we're going to do here is we're going to change the action from buy to sell. And these are all stocks that are falling through a moving average or creating one of those moving average crossovers. One of my favorites is the 20 and 100 day. But again, what I might do here is, first of all, you can go right to the chart here where it says by this little arrow here, and you're going to see the 50-day moving average on your chart, and you can see what the price is doing. Now look at DuPont here, right? A chemical company, right? What do we see here? Is this the kind of the pattern we were looking for, right? Where we're in an area of distribution, we're breaking that 50-day moving average. Let's see that impulse down and then that first retest back. So maybe not an optimal selling opportunity right now, but certainly one that might develop in the next few days or weeks. But look at where our potential is in terms of setting our target, a large gap here. So looking for an entry where we can take advantage of that gap. Now, another way we can do the same kind of analysis and on a very particular moving average or crossover is I can go into new recommendations and we can look for that particular indicator that we like. For instance, here again, here's that 50-day moving average, and here are 81 stocks today are going below their 50-day moving average. Again, on this one, what I would do is always need to do our diligence on these types of trades. But what I'll do is I'll come over here where it says main view, and I'm going to open this up, and I'm going to go to moving averages. And what I want to kind of do is I want to look for those stocks that are falling below the 50-day moving average, but are still above the 200-day moving average, right? That meat on the bone that we're trying to capture. So that's ones that I would first start looking at. But also remember our impulse value, right? We've said that bear markets tend to move in somewhere around, 8 to 15%. So yeah, could I capture a lot of this value? Yeah, sure, I surely could. But I probably want to concentrate on those that are more realistic, right? Right in this kind of range. And the one that I was looking at this morning is, let's see if it's in here. I don't see it, but let's see if we can find another one. Well, it was IP, it was International Paper. And again, here we are seeing that attribute we kind of talked about where price had broken, fallen, it's trying to struggle to recapture or hold above the 50-day moving average, and now it could fall if we get a breakdown here, could fall to the 200-day moving average. And so again, if we look at that in a price range, that is about a 10 or 12% drop in price. Very reliable, very predictable, and also a very definable a trade for us. All right, and the final one is under the investing page. Go down here where it says TTM squeeze. Now, this is a indicator that looks at price volatility. What it's telling us is the market has been in a consolidation period. In other words, that sideways or that maybe potentially that distribution pattern. And I'm going to click on short squeeze. And so what this is telling me is the market has been in a sideways price action and then now is breaking out to the downside. So you can see some of the names here are pretty common names. First of all, let's look at Coca-Cola. Again, right? I mean, here we can see that kind of that distribution as we are holding that 50-day moving average, but today we're broken the 50-day moving average. And so is there room for price to fall? Is there a lot of support here? Maybe one minor level of support. And, what's the distance to the 200-day moving average? Only a 5% movement here. So the question would have been, would I short this one in terms of borrowing stocks and shorting? Probably not. But if I get a 5% move in a short period of time in an options trade, that would probably give me a nice return on my money. So this would be an example of where I'd probably be using options instead of shorting that particular stock. But again, if market conditions were different, or I recognize that this, money was flowing out of consumer staples, then maybe this would be a longer term shorting candidate. Okay, so we're at the top of the hour. I apologize, I didn't get to all of your questions. One question from one of my regulars, Richard. Yeah, could you use RSI or MACDs to be helpful in shorting? I certainly would do that, Richard. I think they are great companion or complementary indicators. I do see also another question here I want to answer is what stocks to avoid into shorting. So first of all, don't sell because you feel the price is too high or that a valuation, for instance, a PE ratio is too high. I mean, NVIDIA is a classic example of that. Right? The market can be irrational for a longer time than you can remain solvent. Two, don't short a stock just because of an overbought indicator, Richard. Again, we want to use those types of indicators, RSIs, stochastics, MACDs, as a complementary or a companion indicator. I have a webinar on RSIs I'm pretty proud of, and I think it's in there. I go into how you can use it in concert, how you can use it to help you find those selling opportunities. And then third, stay away from small cap stocks or stocks that have low volume. Again, the threshold is going to be up to the trader, but stay to the mid caps and the large caps. There's a lot of opportunities out there, and maybe 500,000 or at least 1 million average daily volume would be. It just allows you to get a lot easier for you to get in and out. If you have a stock that has low volume and you get a reversal on you, you could be subject to one of those crazy bear rallies. Now, I want to talk about some takeaways, but before I go away, I want to give you one bonus chart here. Again, let's go back to Walgreens. And if I was going to write a book on technical analysis and talk about shorting opportunities, I would be using this stock as a case study. And what I would recommend to you is go back and look at this stock and see how many of those price patterns we talked about, distribution, breakdown, those little flags, the re-entry tests of gaps, support, resistance, bear market, big bear market rallies where price looks like it's going to rocket back up, but it makes a lower high. And notice that in Walgreens, this is really an anatomy of a death spiral. I mean, it's taken 7 years, but Walgreens went from an $80 stock to today, I mean, we're talking about an $11 stock. Again, time in a trade. Sometimes it takes a while for some of these trades to set up. So let's talk about our takeaways. Why individual stocks or markets may enter bear markets independently. It's the broader market downtrend or bear markets that significantly boosts our profitability and the likelihood of success. And this again underscores that importance of market conditions that might be unique to a sector or to a particular stock, but in the broader picture, if we see a bear market, much more probable events. Former market leaders can also be excellent candidates for shorting because of their extended price movement and market exuberance. Again, we're not going to just jump in there and sell because we think the price is too high or the PE ratio is too high. I mean, Tesla is a great example right now. But we want to wait for those characteristics, those conditions to develop. And maybe we might need to wait for a completion of one of those characteristics before we find an optimal trading opportunity. So patterns like head and shoulders, climax, and distributions are just the beginning of trend changes. You need to wait patiently for both confirmation and those breakdown setups. And the final one is don't be a pig, right? Shorting, we want to kind of pick our spots. We want to get in, get out, ring the register, look for another opportunity. Be reasonable. Don't think you're going to hit a home run, because remember, the market is designed to go up and not down. But certainly, I've shown you a lot of great examples today of major companies that have not participated in the most recent uptrend and have fallen. So, I hope that you guys enjoyed today's session. Again, one of the nice features about being able to set up a lot of these different templates that I showed, or getting able to screen on some of the pages that I showed you, those resources, you need to be a Plus, a Premier member, but you can join for free 30-day trial. So again, talk about a riskless trade. I think this is a great opportunity. I hope you guys enjoyed the session. Next week, I believe we're going to be off. And then in 2 weeks, we're going to have a special guest. So look for that description. Hope that you guys are signed up to be alerted of that. Gene, am I forgetting anything before we end today's session?
No, just that everyone will get a follow-up email to today's session with a link to the recording. Recordings can be found on our webinar archive page in the Learn tab or on our YouTube channel.
All right, Gene, thanks so much for helping me out today. And folks, thanks for joining us. Until next time, best of health, manage your risk, and the good of all trading.